All right, hello there. Justin Stivers with Stivers Wealth Management, a financial planning and investor coaching business based out of Knoxville, Tennessee. So, video today, what I'm kind of talking about are some two retirement tax traps that I find catch a lot of people off guard. A lot of people think that when they retire, taxes are going to be a lot simpler. They're not going to have any paycheck, no withholdings, fewer complications. Now, a lot of people, have an idea about required minimum distributions, RMDs, but they still, generally their expectation is they're not going to be working. Their income's going to be lower. So just a lot less complexities. At least that's what they think. But in retirement, there's often a couple new tax challenges that they haven't ever really thought about or maybe haven't considered, and a lot of them are very easy to overlook. And I just want to talk about them, for the next couple of minutes, and hopefully it's helpful for you. So number one is Social Security taxation, right? So starting with Social Security, a lot of people think it's tax free. Sometimes it is, but very often it's not. And there's a lot of Social Security, there's so much about out there at Social Security. And again, my background, I'm a CFP, certified financial planner, as well as a former estate planning and tax attorney. And people always want to talk about Social Security. Most people hate it. Most people I speak with say it's not even going to be here when I'm around. So, what does it matter? But a lot of people do count it and need it in retirement, or it's at least part of their overall retirement plan. And so we definitely have to talk about it. Now, whether or not your Social Security benefits depends on something that we call provisional income. And that calculation, figuring that out, is going to be taking your adjusted gross income, any tax exempt interest that you might have, plus half of your Social Security benefits. And if that number exceeds a certain IRS threshold, a portion of your Social Security benefits become taxable. And in some cases, up to 85% of Social Security income may be subject to taxation. And why this surprises a lot of retirees is because it makes it's sort of confusing for them, right? It's not that Social Security suddenly gets taxed. It's that other income can cause your benefits to become taxable. So for example, I mentioned RMDs, so withdrawals from your traditional IRA, maybe capital gains from investments, pension income, and even potentially municipal bond, muni bond interest. All of these can increase provisional income, which can cause a portion of your Social Security benefits to be taxed, right? So the real issue isn't just how much Social Security am I receiving, it's what else is showing up on my tax return, right? Because in retirement, those income streams don't operate in isolation. They all work together, they all interact, and that's what ultimately causes some of this taxation. So someone might be thinking, my income is lower now, taxes should drop, but then again, IRA withdrawals begin, investments, they continue to accrue, you're continuing to get income from those investments, and now Social Security starts. So suddenly benefits that, were expected to be tax-free are now potentially partially taxable. So that's something, a kind of tax trap we see a lot of people. And then when we're working with clients, that's something we want to kind of figure out and work through. Second trap is what I've been talking about or mentioned a couple times now, required minimum distributions, or RMDs. That's what they're commonly known as. And so once you reach that age, right, and it varies, but once you reach that required beginning date, the IRS says you have to take money out from those traditional IRA accounts. These are not Roth accounts. These are traditional retirement accounts, whether you want to or not, right? Again, ages are gonna vary. Let's just say roughly at 73, more or less. The government's gonna make you start taking out that money, okay? And these withdrawals, they're generally gonna be taxed at ordinary income. They're gonna increase your reported income. They can push you into a higher tax bracket than you might have been. They may and likely will increase your Medicare premiums, and they can, like we just talked about in the previous trap, they can trigger the taxation of Social Security. So this can feel frustrating for most people. Many retirees are going to say, I don't need the money. Why do I have to take it? But from the IRS's perspective, those accounts, you didn't pay any taxes on that money yet. They were funded with what we call pre-tax dollars. So eventually taxes are going to have to get paid, and the IRS doesn't want to wait more than they, legislate that they have to. So they're going to force you to take those RMDs. And that has kind of a hidden ripple effect in that what catches people off guard is not just the tax on RMD itself, because I think most people are aware they're going to have to pay taxes. And especially as you are getting ready to retire or you are retired, you're paying very close attention or much closer attention to those accounts, and you're probably educating yourself on this. But it creates a chain reaction. So again, an RMD can increase taxable income, which increases provisional income, which we just talked about, which increases Social Security taxation, and which may increase Medicare, what we call IRMA charges. And so once required withdrawal, it can influence, once you're having to take those out, it can affect multiple areas of your financial life. And so that's where retirement tax planning becomes even more nuanced, because it's not that these decisions, you're not just making these decisions in a silo. Those income sources, they're going to overlap. Those tax rules start to stack, and those thresholds can get triggered. So in retirement, income is going to come from a bunch of different sources, as I've mentioned: Social Security, retirement account withdrawals, pensions, for those of you who are lucky enough to have those, again, taxable investments, and then tax-free accounts. Each source of that income is going to be treated under the tax code differently. But more importantly, each source is going to affect how the others are going to be taxed. So retirement taxes are rarely about one single bad decision. They're often a result of interaction between all the different types of sources of income. Timing, age for Social Security and for RMDs plays a very big role when you decide to start taking Social Security or taking payments from your IRA. Again, how the income stacks on top of each other. And then a lot of times we just kind of have a misunderstood a lot of people have a misunderstanding of certain thresholds for both of those things. So retirement does not automatically mean your taxes are going to be lower, but it does mean different tax rules. And so you want to really understand those rules, particularly how those sources interact, and hopefully help you avoid any unpleasant surprises. So anyways, hope you found this useful. Again, we're here to help in any way that we can, and appreciate you watching.